My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Ashraf Laidi, who I had on, I want to say probably 10 months ago. So there's a lot that we got to catch up on here. But Ashraf, introduce yourself to the audience. Who are you? How'd you get involved and interested in markets? And what are some of the specialties that you focus on?
Yeah, hi Michael. Thanks for having me and for taking some time in this weekend. And thanks for everyone for taking time with their weekend and listening. Basically, I'm Ashraf Laidi. I'm based in London, and I do a mix of trading for myself and some discretionary for a few individuals, mainly in the Middle East. I have a WhatsApp broadcast group, which is basically, it's not a signal service. I don't send a signal and then, or a trade, and then people are sitting on a loss, and then I have to send another. Another message. So more in a more the fluid manner, we have a WhatsApp broadcast group. So I tell them what I'm doing with my losses, if I'm hedging, if I'm indirectly hedging, if I'm cutting losses, if I'm moving stops, and so on and so forth. It's very useful. I have one in Arabic, one in English. And what's so important is that when the NFP comes out, basically 8 seconds after that, I tell the clients that even though the NFP beat, you have to look at the 3 other components. And even though the average hourly earnings was firm to neutral, the number was not that positive for the dollar. And so it's a voice note that comes in 10 seconds after the FOMC, or 10 seconds after that. I give them the voice note, and then I'll do it in the charts, and then we will tell them what to do with the trades in Arabic and English. But those who are listening today, who have taken the time to listen to this, don't want to listen to my my ads about my business and so on. They basically want to know how we want to make money. Just to give you an idea, I have a broad experience. My first trade ever was in dollar yen on the phone in 1997. March 1997, I placed it, and I told a friend of mine, I said, if this trade is going to go well, then I'm going to go into this career. Because before that, I was an analyst. I was a fixed income analyst for Reuters. I spent some time with the Treasury of a United Nations subsidiary. I did some energy consulting back with the World Bank. But in the market proper, been getting my hand dirty for at least, I would say, 15 to 16 years. So why are we here? And why? And I wrote a book also in 2007 during the crisis called Currency Trading and Intermarket Analysis. And I wrote it in 2007 while I was in New York. I lived in New York for 12 years. I came to London in 2008. December 2008, and I was writing that book during 2007. It was published in 2008. AshrafLaidi.com is my website. You can find the book there. And it's interesting. I was working on the book in the office on a Sunday evening in a certain March 2008, and right across from our work building was the Federal Reserve Bank of New York. It was 40 Broadway, and I looked down, and all these limousines were next to the Federal Reserve Bank of New York. And what was happening? That was the time when basically J.P. Morgan was about to come in and buy Bear Stearns for $1. Last week, I was at the Orlando Money Show, and I wanted to basically talk about a certain topic that is not only interesting for the attendees there, but I also wanted to make it worthwhile for the other experts who are there. So what we're about here, we're trading. I look at intermarket relationships to trade FX. But when I start to delve deeper, if you know where the dollar is going, if you know what part of the dollar is moving up or down, because people focus on the 7 currency basket of the dollar, and they don't know why DXY is up. Is it because of yen weakness? Is it because of the European currencies? And then is the DXY good to trade? Maybe you should look at the CNY, the Chinese yuan. But what's important for those of you who are listening to know how to be a good trader with Denise Scholl, and some of your listeners are trading Bitcoin. Some of you are trading value stocks. Some are trading Russell. Some of you very well know that it is useful to know what the dollar is doing. So we're cutting straight to this. So and what is important is, why is it important to know what the Fed did? And what the Fed did on Wednesday. So I will talk about what I think the Fed did and what does it mean for for the framework that I use, which is if you look at silver and if you look at the gold to silver ratio, and if you look at the 10-year to 3-month spread, then you are in a very good position to know what the dollar is going to do, what metals are going to do, and what probably indices are going to do. And I hate to sound like a guru who says, all you need for success is these 2.5 signals, or this 1.5 signal, or this 3.5 signal. No, that's not all. But this framework is important, and I look at it, I get dirty on it, I lose money, I make money, but I'm always constantly, looking at it. So before, and I see, and as I'm talking here, the ever so multitasking Michael is tweeting as I'm talking, and he says, the dollar just undid nearly all of its risk-off surge that happened Wednesday following Powell's hawkish presser. Great. So let's just go. So basically, and I hate to characterize some big things as the Fed in a few cute sentences, but what the Fed said, even though they said they're going to continue to go higher in a higher destination, they're going to go up the destination from the elevator to the stairs. They're going to take the staircase. And Michael said, yes, they're actually going to get back on the stairs away from the elevator. Why is that important? Why is that not necessarily so hawkish? Some people said it doesn't matter what's the pace. What matters is they still want to go to 4.5 or 5%. But no, it is, as in every other part of life, it is not only the destination, but it is the journey. And this journey, because they are taking a slower pace, they are getting the ability to be able to, when you're going up the stairs, you can go up 3 steps or 2 steps. You can change your mind whenever you want. And believe me, and the Federal Reserve is notorious for changing their forecast, for revising things, and they can pause. So no, I'm not one of those people who are saying, wait for a pause, put a blindfold and buy stocks. No. Because here is what I think when the pivot is going to come. I'm going to put an asterisk with the word pivot, and then I'm going to take you to the footnote. And my definition of a pivot is not necessarily a 180 degree, not only a rate cut, but as many of you, I'm sure, agree, just a pause. And if they do that, it will be beneficial for equities. It will be great for non-dollar, for commodities. But there will come a time when inflation is going to settle at a higher base, and then it's going to push up. And I think stocks are going to have a hard time. Why? Because bonds may actually sell off again, because they're saying, we are the vigilantes, and we're not happy with this quasi pause. So the stock market is going to fall hard, and I think gold is going to take off. And it will take off.
And let's go with it, because I think there's a lot of things that happened in the last 3 days which I think are being underappreciated. So the dollar went round trip from Powell's presser. Emerging markets, which are supposed to be more sensitive to a hawkish Fed, ended up the week very strong because of China reopening. And I think we should talk about that also in the context of inflation and the staircase. Maybe I'm crazy in this as a theory, but when you look at the 4-year presidential cycle and you look at the best 6 months from a seasonality perspective, November to April, tends to be pretty strong. Maybe Powell knows that, right? And is actually trying to front run that a little bit because he probably doesn't want stocks to run away. But my point is that there is something different that's happening here in terms of the intermarket relationships relative to the narrative that the Fed is going to keep hiking rates, and that's bearish, at least in the short term, for stocks.
Yeah. It is. And Mike, there's so many things you touched upon, and then you added China, and I'm like, oh man, do we have 5 hours? But yeah, I'm going to try not to focus on what they're finally going to do with COVID in China, but I'm going to give 3 bullet points that covering this discussion. First of all, even though gold has fallen to the lows that we saw, has fallen to the September 28 lows, the palladium did not continues to be on a higher lows. Platinum continues to be on higher lows. Copper, I won't even mention copper. And any self-respecting listener on this space, whether they are in in a roller coaster with their kids while listening to this, or they are in the sofa, or they are on the golf court, you see what the copper chart. It's not even a higher lows; it is actually pushing higher. But most of all, silver. And silver is the one I look at. So there's two ways, and the second bullet point is as follows. I look at something called the gold to silver ratio. And the gold to silver ratio, gold divided by silver, also known as the mint ratio, is actually highly positively correlated. It is positively correlated with the DXY, with the dollar index. There's many ways for us to explain this, but it is. But the short fundamental explanation, why is that? Because, hey man, Ashraf, I want to get into currencies. What do I need to do? And then some guy comes in, hey, just whatever the dollar does, gold does the opposite. Wrong, wrong, wrong. There is some sort of an inverse relationship between gold and the dollar, but there is a deeper, stronger, inverse related correlation between silver and the dollar. And because of that, when metals push higher and precious metals push higher, what happened? Gold falls relative to silver, meaning the gold to silver ratio falls. They're both going up individually against the dollar, but relatively speaking, gold underperforms silver, silver outperforms gold. Therefore, the gold to silver ratio drops when the dollar peaks. Now, some people are saying, why on earth do you have to complicate things? Are you trying to drum up business? Why do I want to look at C and D in order for me to find out what A is doing? No, because sometimes when you look at things at a chart, things are not so clear. So you look at the other things that are inversely correlated or positively correlated or quasi-correlated with them. And maybe you will be able to glean more indication from that. And I urge all of you, usually when I'm speaking and I'm doing a webinar, I'm showing a chart. I urge all of you to take notes. This is recorded, or you can look at the charts. So I will give you an example because talk is cheap, and I'll try to tell you what is happening. So this is an anecdote, guys. So I was in Dubai in an FX show 2 weeks ago, and I was sponsored by a company, and I was sitting at their booth. And all these gold dealers from Dubai were coming. What do gold dealers do? They basically give people the ability to trade gold, a spot cash one-on-one, and they cover with some companies in England and in Switzerland and so on. It's a great business model because they just need to hedge and they make money through the fees. Why am I mentioning this to you on a Saturday in a Twitter space with Michael Gayed about my adventures in Dubai? Because what happened after the event, the company had a party at a yacht. So we went to a yacht. It was October the 20th. And there was a gold dealer, two of them, they were with me, and they said, we like your discussion. And the guy was staring at the water behind the engine. And I said, what, are you going to throw yourself? He said, well, I bought gold at 1720. I bought at 1750. I have all these longs. And today, this very Friday, it was a Thursday, the 21st, I believe, gold went to 1615. And I said, listen, I know you are long gold. I know you're losing money, but I hate to be the one to tell you if you're holding X, don't look at X, look at silver. And I am looking at the chart that I showed in the expo, and then I showed to him in my phone on the yacht. And I said, look, and I'm going to exactly take you to the date. So that date was October the 20. So October the 21st was a Friday. I like to explain by examples, by using examples. Because again, talk is cheap. So October the 21st, gold went to 1617. And the guy was, his position was losing a lot of money. I said, look, gold on October the 21st is down, but silver still has a higher low. And silver on October the 21st it went to 1928, and that is called a trend line support. It's called a higher low. It's called a right shoulder that has been respected on the inverted head and shoulder. That's how a lot of these hedge fund guys who may have, what do? They look at Elliott wave, they look at positioning, they look at, volume, but a lot of them look at these. They do a classical analysis to intermarket analysis. They put 3 or 4 graphs and they put them in the same big giant screen. And they tell you that while the yellow thing is going down, while the yellow gold is testing the September 30th low, silver is telling you no. In sophisticated language, you call that a bearish, or you call it a bullish intermarket metal divergence, if you want to be sexy on a Saturday. But we don't want to be sexy on a Saturday. We don't want to use the word divergence.
I always want to be sexy, in fairness.
You want to be sexy? Okay, let's be sexy.
I think we should all, okay.
Well, let's do it. Okay, so basically, and then you say why. There is one explanation that say why is gold doing badly? Because it is more of a victim to speculative activity, even though the central banks in China, they're buying up to the wazoo. It is more vulnerable to speculative activity, i.e. shorting. Not copper, not silver, not palladium, not platinum. Now that I have hopefully convinced you that this signal works, because even though gold, so when I left Dubai on October the 21st, gold went from 1620 to 1670, then came down courtesy of, ahead of the Fed and so on and so forth. But silver, again, don't take my word for it. Look at a chart, overlay a chart of gold, and underneath on top silver, and you see it's still respected. And for those of you who understand inverted head and shoulders, you will see where the right shoulder is. For those of you who are looking where the head is September 1st. Now, let's move on. The gold to silver ratio, also, because I mentioned to you, the gold to silver ratio it moves along with the dollar. And the gold to silver ratio, it had a high on October 14th, but that high matches the high of September 28th. Okay, that's called maybe a double top, and then it never looked up. The dollar, we know, it peaked on September 28th, and the dollar had a lower highs, a trend line resistance, okay, from September 28th, and then you connect October 13th and October. That is not a fluke. Why is that? Because a lot of people, when the dollar went up on September 23rd, do you remember what happened on September the 23rd, everybody? September the 23rd was that when the chancellor of the exchequer of the country in which I live, the finance minister, announced a deluded, crazily dangerous mini budget, leading sterling to crash. And sterling crashed, the dollar did fine, and gold did fine, and the dollar went up. So September 23rd, when the finance ministry or the treasury in England screwed things up, sterling was dumped, the dollar went up, and a lot of people said, this is it. This is another way for me to buy the dollar and to take it from 111 to 116. And guess what? The dollar peaked 3 days later. It came down, went back up, higher low. Went down, went back up. October the 21st, higher low. I'm sorry, lower high.
And again, that's happening with the Fed supposedly being more hawkish, supposedly, right, in terms of the terminology. Yeah. And it's happening. It's also happening when you have, there's this thing, as you know, right, the magazine cover indicator. Right?
Yeah, exactly.
This whole narrative around the dollar wrecking ball, while it's true, the fact that now it's so out there as a narrative, like that should make one a little bit contrarian, right? That maybe it's actually going to have a complete reversal, not complete reversal in terms of undoing all the gains, but at least a different type of a move.
Exactly. And people like you, Michael, with a lot of followers, when you say this it's very important for you to kind of counter what the cover page indicator is doing. And when you point these things out to your followers, you're doing them a favor. But your followers should not just take your heed and say, oh, if every major magazine is saying the dollar is strong and Michael is saying, be careful of the contrarian indicator, before they say, oh, I like that. That's very nice. The Chrysler building, the Empire State Building, they right at the top of, right before the Depression, blah, blah, blah. Oh, but Mr. Contrarian Michael said sell. Well, before you take his word for it, You got to look at the nuts and bolts of the market. And I'll give you another thing. So I gave an example about the gold to silver ratio peaking. I gave the example about the trend line support in silver never losing. I have so many other instruments, but I will give you this other thing. Now, the euro dollar. So I was in the FX market when the Deutschmark was around, but the euro dollar, before it came to being, the Deutschmark, was a big pair. But when euro dollar pair came in, it occupied around 20% or 25% of the daily turnover in the now $7 trillion a day currency market in spot FX. Why does that matter? Because basically it's a big deal. Now, all of you know the DXY. All of you know the DXY, but all of you know that it's not. It is good. It is tradable. It's very liquid, and so on and so forth. But what about the Euro index? So there's something called the Euro index, and it's not really EUR, but it's the one that you see in TradingView and everything. But it's slightly different. This one is prepared by the ECB, and it is against 19 currencies. And the Euro index, and I'll be very happy. You guys can tweet me, Laidi, and you can tell me, hey, Ashraf, I'm not even asking you to go to my website. You don't even go to my service. Go to the Twitter, Laidi, and say, hey, Ashraf, can you please on Monday, can you post that chart, the Euro index? And I will show you something, how it differs from the Euro dollar. So the Euro dollar fell and it broke a multi-decade trend line support and it fell. But the Euro index, it is still, again, sorry to use that word, it is still respecting the right shoulder of the horizontal inverted head and shoulder formation. Inverted head and shoulder formation is somewhat bullish. So this Euro index that I'm talking about, right now, it closed at 94.70. And the low of, by the way, and the low was when? It was on August the 26th. August the 26th. The euro dollar spot rate, which people know about, its low was when? Was September 30th. So the euro dollar index basically bottomed before. And that low is in line with the low from February 17th, 2017. Yeah. And the low was April 2015. And the left shoulder, which is in line with the right shoulder, is July 12th. These are long-term charts, but this is another thing for me to look at. Now, let's go to everybody's favorite subject on this Saturday, 11:28 Eastern, 3:28 p.m. London, or 7:28 Dubai. Everybody's favorite topic, the yield curve. By the way, the book that I wrote in 2007, it did say that it has some things about the yield curve. And why am I talking the book? Because the yield curve inverted in 2005. And when I was writing the book, the yield curve was becoming a steepening. And I'm sure all of you who've been here long enough in the market since 2005, when Greenspan and then Bernanke, they expressed their mystery about why bond yields are going down and they are raising rates. I forgot. It was called Bernanke's conundrum. It was Bernanke's conundrum. Why? They were raising rates in 2004 and 5 and 6, but bond yields were down. And they called it a conundrum. And when I was talking about that, basically yields were down and then the yield curve was inverted. And back in 2007, I wrote about the track record of the 10-2. But I want everybody to listen now. This is if there are two things important that I want people to get, is the following. I don't care about the effectiveness of any yield spread in telling me there is a recession. No, I want something more than that. I don't care about a yield curve telling me there is a recession, because the NBER is going to finally tell me there will be a recession, usually 3 or 4 months into a recession. What I want, and it's pretty ambitious, and there is an indicator that tells you that, and it will show you how to use it, is the following. So I'm sure you've read everywhere that there are 4 ways to measure, or 5 ways to measure the yield spread. The yield curve, the 10-2, the 5-2, the 5-3, And everybody knows by now that the 10-year to 3 months never lies. It's like Shakira, these hips don't lie. The 10-year and 3 months do not lie. Now, but they do not lie in what? No, I'm not going to bore you in being a recession indicator. No, in telling you when there will be rate cuts.
I'm like nodding my head as you're speaking because there's a lot of, I think when you have the mindset of intermarket analysis, you end up seeing things very similarly. So a lot of what you're talking about, I'm seeing in different ways, and it's again counter to a lot of these narratives that are very pervasive in the short term.
Exactly. And you've said it right here. Listen, I'm not here trying to spend 5 hours in analysis to tell you that there is a bloody recession coming. No, I'm here trying to show you this indicator that helps me find out, are we at the last rate hike? Are we before the first rate cut? Now, that's one thing. And maybe we're not at the last rate hike, but the 10-year to 3 months is so good at each time it inverted. And again, I'm going to say this very carefully. And again, if you don't have the means to chart this thing all the way down, and to plot it against the Fed funds, the 10-year to the 3 months, when it inverted and properly, not touch inverted for 2 days and then it goes up. No, when it touched and it inverted and it stayed inverted, that usually happened a few months. Actually, that always happened. Well, always. Again, this is for the 2008 and the 2002, I believe the 2000 and 1990. So it inverted one after the last rate hike, and it inverted right before the first rate cut. And it happened at the last cycle of 2018 and 19. For those of you who don't know what's happening, 2018, the stock market was going up, the Fed was raising rates, and then the Fed was basically, there was the supply. It's very important to have a context, because 2018 and 19 is similar in somehow like today. I know the inflation story is very different, but you need to know the 2018 and 19. A lot of you are experts at it because it happened 4 years ago, but I'm going to give you another thing. 2018 was the opposite, and 19 was the opposite of now, because the Fed back then, they were cutting while the stock market was at record high. I'm going to say this again. It was unusual because the Fed was cutting rates in 2019 while the stock market was at record highs. And some people said, no. The FANGs were at record high, but many other indicators were at higher lows. And I give you that. But I'm talking about the main indices. Today is the other way around. Today, the Fed is raising rates and the market is at a bear market, is at multi-year lows. That never happened. Well, maybe it happened. Actually, I don't think maybe it happened in like 70 years ago. So 4 years apart from some things that are rare. And here is what I want to say for those of you that now I'm going to give the caveat to some people, because a lot of people are being irresponsible. They think that when the Fed pauses or when they cut rates, the market is going to go up and it's going to take off. And that's wrong. Not only because there's something different called inflation, but 2019, that was the only year. It was going to be the only year, 2019, that the Fed was cutting rates and the stock market did not crash. Because usually, by the time the Fed goes from hikes to pause to rate cuts, that it turned the truck, it's because something big deal happened.
But that's actually a really important point, because everyone keeps talking about you're going to have a resumption of the bull market with the moment they pivot. Actually, history would suggest it's the other way around. They're pivoting with
exactly.
Right.
Exactly. But exactly. 1990, the bear, the bond market crashed in 94. They were raising rates and they stopped. And then it came in, Iraq, Saddam invaded Kuwait and the SNL crisis. And then add to that the oil prices. Then they cut rates. And then when Bush Sr. fired the bullets on January 17th, 1991, that's when actually oil peaked and the market took off. And then you had the rate cuts of 98. And that's very interesting because the inversion of 97, or the yield curve inversion, some people said it did not predict a recession. I don't care about predicting a recession. I care about predicting rate cuts. And when LTCM blew up, those 3 rate cuts, I remember this very well, like exactly remember, it was autumn 1998. I was working in Italy. I was visiting London, and that happened. It was September, October, November 1998, and I'm not cheating, and I'm not reading anything. I just have something in front of me, and I'm memorizing this out of my brain. So what happened is that they cut rates, but the U.S. economy was doing well. It was because of Asia, because of Russia, because of Russia defaulted, because of a Brazilian state, Minas Gerais, said we're not going to pay. So it's crazy. And then when they cut rates in 2002, the market was crashing. When they cut rates in 2007 and 8, the market was crashing. Michael Gayed, 2019 was going to be the rate cut cycle of 2019 was going to be the only rate cut cycle that did not happen during a market crash had it not been for COVID. But the great thing about the markets, if it was not going to be COVID, it was going to be something else. And there's many reasons. There is JP Morgan saying we're hurting. And then the last rate hike of Powell in December 2018, it was the last rate hike before the stock market crashed 25% only in December. In December, it was going up. And then in December 2018, the market crashed at 20%. And then it bottomed on the 25th of December. And then Powell had to actually say the word Apple. They had to quote, they have to say Apple is having problems in China, blah, blah, blah. And then 2019, they were cutting rates. And then you know what happened? And then the bond market almost blew up on September 19th. For those, I like to mix a lot of history because I love history. And then they cut in 2019 and then came September 2019. 2 things happened in September 2019. The bond market of the United States of America almost crashed. And the other crash was that Aramco, the oil wells, the oil field in Saudi Arabia got attacked by Iran, by the Iranians via the Houthis. So 2 things happened. And the Fed was cutting rates. But the stock market was going up. And it was going up. And it was going up. And then COVID came in. But it wasn't COVID. It was going to be the broken supply chain which started to break between the trade war between Trump and Xi. Okay, so I don't really focus so much on the emerging markets. I really try to focus on how to read the dollar and effects and yields in what's going to happen for the dollar and then metals. But what you said is totally true. The dollar is up. All these countries based in Asia, Latin America, borrowing in dollars, and then they have to go and they have to jump after the plane and they have to repay, and their costs and their repaying the borrowing costs are going to go up. Yes, it is hurting. Fidelity or Merrill Lynch or anybody, I mean, for them to mention the word November, things may be fine. That's like today. So are things going to be fine today? Yes, they may be right. If the dollar does not peak. So here's the thing. That's the way I look at it. I believe it was a Treasury Secretary of the United States. I think who basically said, the dollar or currency, your problem. Right now, it is the United States currency, and it is not everybody else's, but the emerging markets problem. But it is actually indirectly the problem of the United States via the rising yields. Okay, so. But we know that the rising yield will represent the new interest rate on the credit card of the United States government. So whether you like it or not, the bond yield, and this is no new news, but the date when your debt is 15 or 16 trillion dollars and the rate on your credit card is pushing higher, you have to find a way to bring down yields, and effectively, if yields settle down, the dollar will have to drop, okay? Or will have to weaken, sorry. And we're not talking about a crash. And maybe we need to have a separate space discussion about will the United States dollar preserve its currency, its role as the world's reserve currency, and so on and so forth. The Chinese and the Russians are continuing to broaden their efforts to have other alternatives, but it is not a threat for the dollar. But I don't need a threat for the dollar for me to make some money in going long euro dollar or going short dollar CAD. I don't need a threat. I just need a few indices. So I hope I've answered your question. So I do think that the light at the end of the tunnel is going to come in, and for dollar bears. But we're not necessarily talking a crash or 40% or 30%. We're talking about a correction. Okay. Now, please just allow me just to do one other thing, because there's some. So how do I read the 10-year to the 3 months? So if you take the 10-year to the 3 months, guys, when it bottomed, when it hit inversion on May 2019. When? May 2019. If you look at your chart, you know what happened May 2019? It was an amazing rally in gold and an amazing rally in something that I haven't even mentioned called Bitcoin. Some of you are holding Bitcoin quietly. Some of you have not mentioned Bitcoin since the last Thanksgiving gathering with your families when you were showing off, including me, why you should hold Bitcoin in November at 21. Some of you did not even dare.
In fairness, I did mention it a couple weeks ago because I'm with you on this. But yeah, keep going.
So what is amazing, if you see the time that the 10-year to the 3 month inverted, and I mean, it deepened and deepened, and that was in May 2019. May 2019 is what? Is 5 months after the last rate hike, December 2018, and 2 months before the first rate cut. And when the inversion happens, it happens right in between. Again, after the last rate hike and before the first rate cut. Is it going to happen now? In order for us, and when that happened, gold pushed up and Bitcoin pushed up. But in order for you, now for those of you who don't have the fancy metrics, you look at the 10-year and the 3 month, and you don't have a trading view, you can program that. You can get the spread. You can go to tradingview.com and you can get that, and you can call your chart anything you want. But if you can't be bothered to do that, then don't do it. And then don't ask me how to make money, because you can't be bothered. But there is a way. If you can't be bothered and you want shortcuts, because we all like shortcuts, just look at the 10-year yield. Why? Because the 10-year yield, a 3 month spread, what is it? It is the 10-year minus the 3 month. But guess what? The 3 months does not do a lot of the movement. Most of the movement is done by the 10-year. And that's why you have to read the technicals of the 10-year. And that's why even if the 10-year goes down on a 2 steps down, 3 steps up, it is still not hitting the high. Maybe 4.5 was a nice case. But for those of you who like cycles, like Yanni, who is my a Greek partner and trade, he loves his cycles, and he pointed out something, and it's something called the 75-77 week cycle on the 10-year yield. I will say nothing more about this. You just write it down with your pen or paper, and you go on your chart, and you look at the 75-77 week spread in the 10-year yield from 2014, and it will tell you that we may have peaked. But don't take my word for it. You check it out. It's not a very clean one. You're off by 3 to 4 weeks. So that is another of the this is another part of the armory that you're looking at. You look at yields, you look at the gold to silver ratio, you look at how silver continues on a trend line support, and then you look at the gold to silver ratio. I could even tell you what the gold to gold box index does, but that will be taking things too crazy because we have 10 minutes left. But the gold to gold box ratio is a whole thing that you can look at. But Bitcoin is telling us something. And when Bitcoin becomes so boring, while all the crazy, sexy indices are going nuts, that is telling you something. There is a big trend line resistance, in Bitcoin and Ethereum, and it's being tested. I'm not going to give you anything about, the merge and Ethereum and the fall of governments and what happened in England was going to be the beginning in other sovereigns. And this is the wet dream that every Bitcoiner have been holding to. You all know that, all of you. I am just going to talk about the price. And the price is that when the volatility shrinks to nothing in Bitcoin, while everything is going nuts, that is something. Guys, listen, between the last rate hike of 2018 and the first rate cut of 2019, that was the smallest period of time between a rate hike and a rate cut. When the secret of the temple of the Federal Reserve, of this indelible institution that's 250 PhDs, when a truck needs to move to go 180 degrees, when the distance between the difference between a cycle, is shrinking and shrinking, And for this institution to do a rate hike in what is it, December 18th, and a rate cut in May 19th, that means the cycle is screwed up. And we know that because the market is telling us something, the economy is telling us something. And that is why, Gino, the sequence of events could be as follows. This could be like the 70s. I believe it was the 70s when you had a rate hike and a rate cut in the same year. Because Volcker was raising rates, then he stopped. The growth was, he was no Arthur Burns. Arthur Burns was basically, he was running Nixon's monetary policy, copy and paste what he tells me. Volcker came, he punched his chest, he said, I'm a big man, I do it. He raised rates, and then he came down, and then he said, okay, I'm going to go in with another rate hike, but this time, and a lot of people don't know this, and again, history, the reason on interest rates went to double digit in the 80s, it's not because he said, today I'm raising rates to 15%. No, because he moved the targets. He was targeting money supply because he found it politically undoable for him to say, we are raising today the interest rates from 50. No, he was raising the money supply. He was withdrawing liquidity, and he was tightening because he said, I want that M1 and M2 to go down. I'm not targeting. I don't want to even publish the interest rates. By interest rates were so that's how they easily went back up. Now, obviously, the debt is 4 times more and blah, 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 and we all know that. So they cannot afford to do that. But here's what I think. I think that when you have somebody like Yellen and some people in the Fed saying, oh, Treasury buybacks is part of the game plan. They're talking about buying back bonds. Is that a form of QE? Maybe, maybe not. But that might be more dovish for bonds than bearish. Like the magician, they will be announcing higher rates with one hand, but with the other hand, out of the other hat, there will be probably, they can soften the QT. The quantitative tightening, they will soften it. The results or the consequences or the effects of a pivot could manifest themselves in the market, not by the Fed saying we're stopping, but by finding out that QT is less, or they're not going to do QT anymore. You know, Yellen said, we're going to do QT and we're going to watch it like paint dry. And then everything blew up. This now, so one thing is for QT to cool. And going back to the 10-year so again, I want to spend more effort in answering the question because I don't like it when I find myself that I haven't answered the question. But so what they could do, I think the market, you know what's another, another definition of a pivot, Gino and everybody else? Guess what? The Fed does only 50.
This is, by the way, this is an important point because I keep emphasizing that point. Pivot, people assume means they cut rates. Pivot just means a change in the direction.
Thank you.
Right. And the pace can be negative, right? I mean, even directions about pace being positive or negative.
The reaction function of the Fed and the market is becoming high frequency trading on steroids. Powell comes in 13 minutes through the press conference. He blinks and the algos go and they behave like they cut rates by 75 basis points. We are in a very high frequency trading, GameStop, press on a button, everything move kind of world. That means that when the Fed will do only 50, and I'm not even going to speculate what happens if the CPI, next Thursday, if the CPI is going to be 0.1% less, that's not going to say a pivot. But when they do 50, and I think they will do 50, then that will be very bullish for the market. But the problem, when I warn everyone, and let's keep things real. Don't ask me what happened. Ask not what your country can do for you. Don't ask me what the market will do when they only do 50 or they only do 25. No. Because we know what's going to happen. Bitcoin is going to go up the roof. Stock market is going to go up the roof. Don't ask me that. Ask me or ask yourself, will the Fed come in and rein in the party like it did when the market took off in June and July? After the June FOMC, people behaved, that was it. It's going to be the last rate hike, blah, blah, blah. And the market went up 18%. Oh, by the way, for those of you who trade the S&P, If the market is up now right now at 12%, and if it goes back up and all the way to 18% from the low, that 18% will be in line with the 200-day moving average, which is 4,100, which is the same run that we went from the bottom of June to the 200-day moving average. And guess what was the magnitude increase? 18%. But also, so that was a side note. So what they will do, the Fed does not like it when they are away from the house, the children are playing. And that is what happened. The blackout period comes in, they don't talk for 2 weeks, and the kids are watching bad movies. They're doing too much, internet while the parents are away. And that is exactly what the Fed is going to do. Any slight hint of pivot, whether for you a pivot is only 50 basis point hike, whether a pivot is a comma before a quote, before a drastic, or before something by some, call it whatever you want to call it, anything that is concrete to push the market up, do not expect the Fed is going to let you play. They're going to come in. And if I'm not mistaken, so correct me if I'm wrong, Michael, or anybody else, but they were talking about doing away with the blackout period.
Yeah, I recall seeing something along those lines. Look, I made this point before. I think this is going to be like a game of whack-a-mole because you're in this best 6-month period, right? So the seasonality is going to be against the Fed's hawkishness, which means they may try to counter it with words, but they're probably going to fail because I keep going back to FOMO is more powerful than Fed policy.
Just want to shift gear back towards towards gold, and there is an indicator that I haven't mentioned, and I would like to mention it, and I'm going to end with this, and this is the very indicator that allowed me, that helped me to call the top in gold on Friday, August the 8th, or I believe it was the 7th, 2020, and I was watching a lot of indicators. I was watching this indicator, and unfortunately, I was not able to call all the declines in gold. I was actually, the best trade that I made this year was long euro sterling, and we don't have time to cover it. But I lost money going long gold. I did, and I had to close many positions and so on and so forth. But in life or in trading, I'm going to put a little bit of Denise Schull in here. It's the famous thing, which is it's not how you fight, but it's how you get up after a fight. And it's when you when you trade and you're looking at an indicator and it is wrong, or and you are right for 2 days or 3 days, and then boom, and then it drops and then you lose money. In my case, it's a little bit different, but if I want to get back on a trade, I need to convince myself. But I also have these followers on my WhatsApp broadcast group, and I need to be able to convince them. Not because I have an amazing ability in brainwashing people, no, but I need to sell it for me, and I need to sell it for them. And then I allow a lot of people to come and to correct me. And so this indicator, and I'm giving, this is something that you really want to look at, is that what gold does relative to its 200-day moving average. Again, what gold daily does to its 200-day moving average, it is right now at a level that is in line with a rebound, just like it was on March 2021, August 2018, December 2016. December 2016, for all of you who know, that was the big high in the dollar, the big low in gold 1 month after Trump won. And then gold fell in January 16, the dollar. So what is gold doing right now as far as the technicals with the 200-day? It is doing something similar. So in the last 3 weeks, it did something similar to what it did in March 2021. And we all know what happened in March 2021. It was a big rally. And what it did in November 2020, and what it did was the bottom of 2016. So, guys, we spoke for 1 hour. I tried this. I think we couldn't have gotten more intermarket than we did, but if we had another half hour, we would have gotten it. But when I talk about the 10-year to 3 months, don't let any guru tell you the yield spread is, the inversion is telling you has a great success in telling you whether there's going to be a recession. No, tell me, is it useful in telling me when is the last rate hike or am I going to be wrong by one more rate hike? And when is it going to be before the first rate cut? And then if that doesn't work, you look at the gold, you look at the gold to silver ratio, you look at the technicals, you technicalize the intermarket analysis, and then you look at the silver, and you look at the copper and all of that. And all of this that I said, it takes 7 minutes to say it, but in today's world, everybody in their basement, they have 2 screens. Each screen has 4 charts. You can program, you don't have to program, you can put anything. And you want to wake up in the morning, and before you even finished your first sip of coffee, you have covered all of those indicators. It's not whether you get the indicator, it's whether you understand them. And technical analysis, when you technicalize all this stuff, it is an art. What to fade, what not to fade. And that's where I can end.
Thank everybody for joining. I always enjoy listening to you and talking to you, Ashraf. I'll have this as a podcast under Lead Lag Live. And thank you, everybody. I'll do another one tomorrow at 10 Eastern. Thank you, Ashraf.
Thanks very much, Michael, for doing it. Thank you.
All right. Cheers.